Good afternoon, all. I can see some attendees have made it in from the waiting room, so I'll give it a quick 10 seconds, just make sure everyone makes itself across. There you go. I think everyone has made it into the actual webinar itself. So first of all, thanks for joining. We are running 3 webinars today, so this is webinar number 2. I know when we looked at it, the booking wise, or there were some people booked across them all. So this one is actually going to be focusing mainly on the changes affecting housing associations, as well as a touch on the current draft housing SORP. So if you're a charity or a commercial client, while some of it will cross over, there'll be sections of this that wouldn't actually apply to you. So we do have a session later on this afternoon for our commercial clients. So if that is of more interest, please feel free to jump onto that. Looking through, so just to give a little bit of an update, I'm Michael Jones. I'm one of the partners here at Bevan Buckland, and we've got Llinos Williams, who is our audit director and one of our housing champions as well. So hopefully we'll give a little bit of insight into what's actually being changed. The reason for this, why are we actually sort of putting these webinars on? The FRS 102, which is the accounting standards in the UK, were updated a little while back, and then the relevant SORPs are going through or have been updated as well. So what we're trying to do is give a little bit of an update on what the changes have gone through FRS 102, what the likely impact is on you, and what we can actually see coming through in the new SORP as well. Focus of today is that there's a couple of key changes. So the main changes in FRS 102 are around income recognition and a new 5-step model, and the introduction of lease accounting more in line with international accounting standards. So that's where the majority of this sort of time we'll touch on. We haven't got the time to get into it in full depth, so lots of this will be higher level. But what we've got, which you should have at the bottom of the screen, got a little Q&A box. So if you've got any questions, please feel free to put them in the chat. Where we can answer them online, we will. If we need to sort of send it as a follow-up with the slides, we'll do so at that point as well. So a little bit of housekeeping there. We're probably looking at about a 45-minute presentation, a little bit of space then at the end to run through any questions that we get. But first of all, I said I've do a little introduction, and Llinos is going to sort of take us through the initial part, which will be the income recognition. I'll then touch on lease accounting, and then Llinos will run through any other changes that may come as part of the current consultation.
Thank you, Mike. So today we're starting with one of the most important areas of the upcoming financial reporting changes for the sector, income recognition. FRS 102 has undergone a major revision through the latest periodic review, introducing a new approach to recognising income that is far more structured and principle-based than before. The key change is a move from recognising revenue when risks and rewards transfer, and instead adopting a model built on performance obligations and the transfer of control, closely aligned with international standards. So this new framework means organisations will need to look carefully at what goods or services they've promised, how those promises are priced, and crucially, when they actually deliver the customer or the service user. So in the housing sector, these changes matter because your income streams are varied and often complex. Rent, service charges, support contracts, shared ownership sales, leasehold recharges and grant-funded activities all have different characteristics. Alongside the changes to FRS 102, the draft Housing SORP 26 builds on this new model and then applies it specifically to the realities of social housing operations. It provides practical guidance where judgment is needed and aims to bring consistency across the sector. So this session will take us through a new income model under FRS 102 and then explore how the draft SORP interprets and applies these principles for housing providers. So before we look at the Housing SORP applies the new model, let's take a moment to understand exactly what has changed within FRS 102 itself. So the FRC periodic review was significantly revised Section 23, bringing in a new, more robust and more consistent way of recognising income. The old model relied, as I said earlier, heavily on when risks and rewards of ownership passed. Under the revised FRS 102, this has been replaced by a model that focuses on control when the customer actually gains the ability to direct the use of the goods or services. This is underpinned by identifying performance obligations, essentially breaking down what has been promised and recognising income as those promises are fulfilled. For most organisations, this will mean a fresh assessment of how and when income should be recognised, and far more complex arrangements that could change both the pattern and timing of revenue. These amendments are effective for accounting periods beginning on the 1st of January 26, with early adoption permitted if all periodic review changes are adopted together. With that foundation in place, we're going to move on to the 5-step model. So this model is designed to ensure that the income is recognised in a way that reflects the economic substance of what the organisation actually delivers, not simply when cash is received or invoices are raised. It requires us to start by identifying whether there's a valid contract in place and then break down exactly what has been promised within the contract, the performance obligations. From there, we determine how much we expect to receive for delivering these obligations, including any variable or uncertain elements. If there's more than one obligation, then we allocate the total contract price to each obligation based on the value of the individual components. Finally, income is recognised not at the point of invoice or cash receipt, but when or as the entity satisfies each performance obligation. This might be over time or at a specific point in time, depending on the nature of the services provided. This is a principles-based control-focused model, and it forms the backbone of how the revenue will now be assessed in FRS 102, and importantly, how the Housing SORP interprets these principles for the sector. So which section of FRS 102? Income for social landlords does not fall under one accounting section. It spreads across 3 separate parts of the standard. Section 23, revenue from contracts with customers, applies for where income relates to service provisions, management services, service charges, support delivery, and so on. Section 20, leases, applies when the landlord grants a lease or tenancy, most commonly social housing tenancies. And Section 34 covers specialised activities relevant for landlords involved in care services, shared ownership, staircasing activities, construction contracts, and complex arrangements. In practice, a single agreement can have components that fall into more than one section. Therefore, you must identify the components part of income before applying the correct rules. Social housing tenancies are treated as operating leases. So Section 20 of FRS 102 governs rental income. The core principle is straight line recognition. This smooths rents across the rental period. There are 2 exceptions. When another systematic method better reflects how the tenant uses the property. When rent increases are linked to inflation-related indices, that's an example of when that could happen. But in practice, almost all social landlords use straight line, and any deviation must be clearly disclosed. Where tenants pay rent early, which often occurs with weekly or fortnightly direct debits, landlords must treat these as deferred income. This ensures income is matched to the periods that the tenant actually occupies the property. Deferred income can also rise in leasehold schemes where building cycles differ from occupancies. So we now look at the Housing SORP. So now that we've looked into the changes in FRS 102, we can turn these now changes specifically for the social housing sector. So this next section introduces Chapter 10, Income, of the Draft Housing SORP 26 edition. Chapter 10 is where the SORP provides sector-specific interpretation of the wider FRS 102 principles we've just covered. It takes a general revenue model and translates it into guidance that is relevant on how social landlords' activities operate. Where FRS 102 gives us the framework, the SORP gives us the practical application. It helps us interpret the model for mixed tenure developments, service charge arrangements, supported housing contracts and other areas where judgment is required. Chapter 10 focused specifically on income arising from exchange transactions. In other words, situations where the landlord provides goods or services and receives payment in return. Social landlords have multiple types of income, such as contractual, some are lease-based, some arise from services or support, and others linked to different sections of FRS 102. These streams may look similar, but the underlying accounting requirements can differ significantly. It is crucial that the income streams are correctly classified and recognised. Chapter 10 therefore sets out clearly when SORP-specific guidance applies and when we should fall back on the underlying requirements of FRS 102. And importantly, non-exchange transactions, for example, the government grants, donations, do not fall under this chapter. They are covered in Chapter 15. So with that in context, let's now look at Chapter 10. So tenancy can service charge and non-lease commitments. So tenancy contain multiple components, and the SORP requires landlords to separate rental and service charge income. So service charges are non-lease components, meaning they must be counted underneath revenue for contracts with customers. This prohibits service charges as an extra rent. They are payments for distinct services. So examples of this is the communal, cleaning, lighting, shared ground maintenance, lifts, door entry systems. When service charges are part of an agreement, landlords must allocate total consideration using the relative standalone selling price method. So standalone selling price is where the landlord would charge for services if they were sold separately. For service charges, this price is rarely observable, so social landlords do not typically sell communal cleaning to third parties. Therefore, the SORP instructs landlords to use expected cost plus a margin. This ensures charges reflect forecast costs for delivering the services, reasonable management, or overhead recovery. This method improves transparency and fairness, especially under increased scrutiny of service charge accuracy. Under Section 23, service charges are treated as performance obligations within a contract. These obligations are nearly always satisfied over time because services, cleaning, lighting, gardening occur continually. Revenue is therefore recognised over the period services are delivered. Variable service charges, those based on actual cost, must be reassessed as new information becomes available. This mirrors IFRS 15 principle and avoids misstating income partway through the year. Under recovery happens when service costs exceed service charge income. These amounts cannot be recognised as revenue or receivables unless the landlord has a customary business practice of recharging these deficits. Many social landlords choose not to recover deficits from tenants, meaning the loss sits in with costs and not within income. This is an important control measure, preventing landlords inflating income when amounts they won't actually recover. Sinking funds and related liabilities. So sinking funds relate to facilitic works, roofs, lifts, windows, and structural items. Contribution to sinking funds are not revenue. They are prepayments towards future obligations. They do not create a new performance obligation. They simply pre-fund works that will happen in future periods. The income is recognised when the works occur, not when the money is collected. Until then, the funds are held as deferred income, improving transparency and avoiding inflated income figures. Where sinking funds contributions are repayable or intended to reduce future service charge costs, they must be recognized as liability. This includes, so such treatment ensures the funds are not misrepresented as income and the leaseholders have clarity on how their contributions are being used. A fundamental principle of service charges, each scheme operates independently. Surpluses and deficits must not be offset across schemes unless there's a legally enforceable right to set off. This prevents cross-subsidization, a major fairness requirement for leaseholders. It also aligns with consultation legislation with regulatory expectations. Income from managed income. Sorry, I just lost my slide. Sorry about that. Sorry. In some cases, landlords own stock but outsource management to another organisation. The landlord must determine whether the contract is with a managing agent or directly with tenants. Key considerations include who sets rent and charges, who bears voids and arrears risks, who controls expenditure, and who carries revenue shortfall risk. This assessment determines whether income is accounted for under Section 20 or Section 23 contracts with customers. If the contract is with a managing agent, it's not a lease, so income falls under Section 23. So if the landlord has a direct relationship with tenants, or if the arrangement meets the definition of a lease, then income must be recognised in accordance with Section 20. These judgments must be documented and reviewed because they affect revenue classification and regulatory disclosures. Properties developed for outright sale or shared ownership first-chance sales are classified as inventory rather than property, plant and equipment. Income from these disposals is recognised in a statement of comprehensive income at the point of legal completion, reflecting the transfer of risks and awards. Non-refundable deposits received prior to completion must be recorded as liabilities in the statement of financial position under the promised goods are transferred. This approach ensures compliance with Section 23 and aligns revenue with the transfer of significant risks and rewards. Social landlords must comply with disclosure requirements set out in FRS 102, including Section 20 and 23, as well as additional requirements imposed by sector regulators. These disclosures typically include detailed breakdowns of revenue components such as rental income, service charges, sinking fund contributions, and income from managed properties. Regulators may require analysis by turnover. Comprehensive disclosure enhances transparency, supports stakeholders' confidence, and ensures compliance with statutory regulatory frameworks. Failure to meet these requirements can result in regulatory sanctions and reputational risk, underscoring the importance of robust financial reporting practices. And to finish this sector, the final two slides bring everything together. What we've set out here is revenue recognition by income stream, essentially a practical framework that organisations can use both for assessing revenue recognition and for preparing the required disclosures in the financial statements. So your rental income, so this is excluding your service charges. For rental income, revenue continues to be recognised over time because the right to occupy the property is delivered continuously through the tenancy. Recognition is generally on a straight line basis over the lease term, aligned by the rental period set out in the tenancy agreements. Key consideration here is include any rent-free periods. For example, like as the council do, they charge rent over 48 weeks, so you need to consider that element. Timing differences between billing cycles and rental periods, and ensuring that accountancy treatment truly reflects the period of occupancy. Affordable rent income follows the same principle recognised over time. However, where a single payment covers both rent and service charges, the components must be separated. The rent element is recognised here and the service charge element goes through the service charge income line. This may require system updates or agreed calculations to ensure the split is accurate and consistent. Service charge income is recognised over time, but with different bases. Income is matched to the period in which the services are provided. This is an area of significant judgment because of bundling of services and the presence of variable consideration. For example, actual service cost differences that merge after the year end. The SORP expects entities to demonstrate clear logic and consistency in how they are recognised. Supporting people income. Supporting people or similar support contract income is again recognised over time, but the basis depends on the contract type. For spot contracts, the revenue reflects the support hours actually delivered. For block contracts, income is recognised at the fixed periodic amount. Billing is often on a 4-week cycle, so timing differences may need to be monitored to ensure revenue recognition aligns with delivery. First chance sales. For first chance sales, shared ownership sales, revenue is recognised at a point in time, typically on legal completion. For organisations retained an interest in the property, but the first chance sale represents the transfer of control of the equity share. That's the performance obligation, and that's when revenue is recognised. Grant income. For government grants, the key message is that Section 24 of FRS 102 is unchanged. So the existing recognition rules for social housing grants and other government grant funding still apply. Where the grant relates to an exchange transaction, for example, a grant tied directly to services delivered, Chapter 10 may apply. Where it doesn't, the grant is addressed under Specialised Activities Chapter. Subsidiaries and other revenues. For subsidiary income streams, repair contracts, solar panel income, development services or other commercial activities, recognition depends entirely on the nature of the contract and must follow the 5-step model. These can vary widely, so each contract type needs to be assessed on its own terms. So what this analysis demonstrates is that the 5-step model provides a consistent framework and application will differ by income stream depending on the nature of the goods or services provided. Using a structured assessment like this will help organisations ensure consistency, identify areas of judgment and prepare clear and compliant revenue disclosures under both FRS 102 and the updated Housing SORP. Ultimately, it gives boards, auditors, regulators and users of the accounts a clearer understanding of how revenue is generated and recognised across the organisation. And now we're going to hand over back to Mike for the accounting.
Thank you, Llinos. Let me make sure my slides are controlling. There we go. Right, so the other main change, with FRS 102 is all to do with lease accounting. So just a little touch on. How's my clicker not working? Nope, too hard. First of all, what is a lease? A lease actually gives the lessor, so when I actually give a lease to somebody, they get the right to control, an identified asset for a period of time in exchange for some consideration. One of the fundamental things there is probably the fact that it's an asset. So, what we'd look like, when we're reviewing accounts, when we're actually sort of doing the work in the back end, we'd look for regular payments. So from a management point, what we're regularly paying for, does that actually give us right to a particular asset? So you could be paying a monthly payment for consultancy costs. It's only access to a particular service. There's no asset involved itself. So we wouldn't classify that as a lease. Whereas if you're actually paying a monthly payment to have access to a motor vehicle, you get access to it for a 2, 3, 5-year period. You've got the asset, you're paying for it, so it then meets the definition of a lease. So from our side, the initial point would be, right, we need to start looking at what these leases are, how we sort of need to factor them in. One thing to also consider is that the lease itself may be more than just a lease for an asset. So quite common, we'll see rent for a building. The building itself, whilst you've got a rental agreement, it may also cover cleaning, it may cover service charge costs, it may cover electricity as well. We'll have to break that lease cost down to what the asset element is and what the service charge element would be as well. So there'll be a little bit of work to identify what the leases are before we actually go into the accounting itself. Looking at this, when does it apply? Llinos has already mentioned, FRS 102 came in from the 1st of January 26. So for most RSLs, that'll be your March 27 year end. I know there are a couple with December 26, but most will be March 27. Because the SORP is still going through consultation, you do get the option to early adopt if you want to, but then you'd have to early adopt all aspects of the standard rather than just the lease accounting model. With the unknown amount or changes with the SORP, it's going to be difficult to early adopt just because we don't know what the changes are on the SORP yet. So I imagine most associations will be doing the changes from next year, but there'll be a little bit of work to do to make sure you know what the changes are, how it's actually going to impact you. And lots of you will be probably going through preparing your budgets for next year, so updating systems, updating some business plans, and then probably engaging with stakeholders to know what the changes are. So, it's good to sort of know what's likely to change, just so you can sort of start that preparation work to factor into your reporting. Why are things changing? Within the UK, there's been an amendment to the standards. They're trying to get them closer to international standards, which are IFRS. So we've seen over the last couple of iterations of FRS 1 or 2 themselves, getting closely aligned to international standards. And that's why we've now got the changes to revenue recognition and lease accounting. Whilst there are still some differences between the two, any external user will be able to pick up a set of accounts and understand what's actually going through the system, and trying to make sure it's as consistent as possible across the world, realistically, or whatever sort of standard you're applying. It's to make sure that the transparency is there. So we've seen it with companies, we're seeing it now with charities and housing associations, is that they're trying to bring everything where possible onto balance sheet. Previous versions, it was a case of let's recognize share options. Now they're looking at leases on balance sheet, so that if you are an external user, when you actually look into the accounts themselves, you can see what the obligations are, what the true position of any organization would be, and how strong that organization is as well. So that's the movement of travel with the standards. Obviously, it's been pushed through the FRC and the relevant reporting bodies just to try and get as consistent a reporting picture as we can. What they've also done as well is, when we went back to our accounting studies of a number of years ago, there was always, what is the definition of an operating lease? There was always the transfer of risk and rewards. There was always a bit of uncertainty. There's always an argument of, this is an operating lease, this is a finance lease. We want to treat this through the income statement rather than capitalizing it. But the actual changes now with FRS 1 or 2, they've almost removed operating leases and actually tried to make everything a balance sheet item. So it's a simplified accounting to a point, because they've actually sort of made it all a capital item. So hopefully it'll help people. There's still a little carve out for sort of short-term low value items, but in the main, most if not all leases will be actually treated as an asset in the accounts. Looking through then, so what does this actually look like? It's fine for us to say it's an asset on the balance sheet. There'll be a new type of asset. So actually on your balance sheet itself, there'll be a new line within your asset section called a right of use asset, which we sort of noted as ROU here, but it will stand out on its own as a separate sort of class. What you then have to do is to bring in the asset, you also then have to bring in the lease liability. And what you're looking at this point is what the value of that lease is. So for anyone that has done any sort of accounting, you end up having to discount the payment. So if you've got a 5-year lease and you're paying £1,000 a month for it, £1,000 today is worth less in 5 years' time. So you have to discount those payments. So from an example point, you do a present value calculation. That then gives you your lease liability. What you then do from an asset side, have you prepaid any costs? Are there any dilapidation or restoration costs, any sort of incentives in there? And that gets you the difference between the asset itself and the lease liability. In the main, there's not going to be much difference between the two items, but you are looking at potentially a couple of costs at the start and the end that will affect the right of use asset. The other thing to sort of look at is what the actual lease term would be. So as part of your calculation, you'll have to look at the conditions within the lease. So you could have a lease with a 5-year break, a 10-year break, and possibly a 20-year break, depending on what's in there. You'd have to actually decide what your plans are. How reasonably certain are you to either trigger the break or extend the lease at that point? You have to have the ability to be able to terminate the lease. So if you were looking at a property where there's 3 options, you can break after 10, or after 20 years you can extend it for 5. As a as an organization, if your intention is we're going to be within the building, we're going to take up the 5-year extension as well, then your expectation is this lease will be over 25 years, and that's where you sort of do your calculations on. If it's the other way around, we're actually, whilst there's a break clause, it's actually triggered from the lessor instead. You can only go by what the terms are in the lease rather than what your expectations are, especially for an extension. It's again something that you'll also need to reevaluate. You could go and lease a number of properties this year, with a full business plan. 5 years down the line, the business plan changes. You want to end up doing it could be a stock swap. There could be a case of we're moving head office. We've outgrown, we're downsizing. Well, suddenly those expectations change. You will then have to sort of reevaluate the lease position and whether there's any acceleration to depreciation or potentially disposals at that point. When you're looking at the lease itself, if you've gone in and as part of the building you've done a significant refurb, and there's going to be costs incurred to actually put it back to the original condition, whereas you previously bring in a dilapidation provision over time within the accounts. This is something that would actually get factored into the right of use asset. So it could increase the asset value when you're sort of doing that initial sort of calculation for the asset and lease liability split. FRS 102 it almost doesn't give an example of what short-term assets are. It almost goes the other side of, gives you a breakdown of items that aren't classed as short-term. So it's specific with cars, with vehicles, with equipment, especially plant and machinery equipment, that these can't be low-value items. But what you need to do is actually look at what you're leasing, what is the value of that, to try and find that, to agree whether that would meet the definition of low value. So if you can do the exercise, do the identification, please reach out to us. We can confirm either way as to whether it would be short-term or not. FRS also sort of mentions sort of below market leases, and then actually increasing the value with donated items, or whether it's sort of grant income as well. So there are a couple of other things to think of where you haven't got your typical market rent, or you're not paying a typical market rent. So any leases that are sort of less than 12 months, or there's no sort of purchase option, wouldn't be capitalized. I say if you've got laptops, small equipment, typical sort of fixtures and fittings, office things, they may well be able to be classed as non-lease assets, at which point you'd carry on treating them as you would normally. Hopefully, it'll then sort of get a bit more sort of consistency around the sector. We do see a number of entities where one may capitalize it, one may actually expense it. So the fact that the simplifications are coming through, it should make accounting easier, and sort of remove burdens when actually sort of treating FRS. The difficult part will almost be getting it into the account in the first year. I think when you're in the model of accounting for it, it'll be something that'll become part of the course. As I said, waiting on the actual sort of SORP itself, but I know generally there's a special accounting treatment for below market rent leases. It'll typically involve some potential grant income being recognised, albeit it'll be an increase in cost and an extra income line recognised. But it's worth reviewing where you've got these in place just to make sure you actually get the accounting right. Lots of the standard, the way it's sort of noted, is everything should be almost grossed up in the accounts rather than actually what the cash payment would be. So the lease liability will again reflect the true obligation of what the charity is likely to pay, and so the right of use asset. Whilst it's not an asset that you actually own, you are getting benefit from it. So it will sort of show the use within the accounts. There will be some additional disclosure. So if you've had to calculate the value, you may have to put an extra disclosure in for accounting estimates as to where you sort of got from it. And if you actually have brought in grant income because of the discounted rent, the method for sort of bringing those in will actually need to be recorded as well. From an audit side, if these amounts have been brought into the account, so we'd need to see evidence of calculations, what your method is, and sort of why you've actually got to the value. It may be a case of we've got 2 leases. This one is grant funded, so we're actually paying less on it, and we've got property 2 that is market. So we've got an easy calculation for what that grant element would be. If you haven't got it, you may have to do that bit of an exercise of market rent would be X, we're paying Y. We've got a notional grant of what the difference would be. Company size thresholds, as I said, these are quite standard slides. Obviously, they wouldn't necessarily apply to housing associations, but things to be considering. It's going to increase your fixed asset position, and obviously your overall liability. The bottom line of the balance sheet will have minimal changes, but obviously there'll be sections within the balance sheet that will change. One thing to think about and consider, and it's probably worth doing a bit of a model with it, is what are your loan covenants? What are they based on? Is there a gearing ratio? The fact that you're going to end up with an additional fixed asset, but part of that loan will be current. It will have a squeeze on gearing ratios. There'll be a little bit of timing that will affect your income statement with the release of depreciation, with the release of the implied interest within the lease. That's probably going to be a lower impact than the split between fixed and current across the two. So do a quick remodel, have a look to see what your covenants are. Is there any impact? Just you can then sort of speak to your lenders early. And it's we know there's been changes to covenants in past years. We know that even under the last iteration of FRS, some funders are still requiring covenants under old standards. So whilst the changes apply so countrywide, the funders may not necessarily have revisited the covenants. So definitely worth a contact with them if you are getting close to any of the limits. So recognition. So when it sort of comes through, just like sort of mentioned earlier, it's present value with the lease payments, with any sort of adjustments coming across. Practically, you haven't got to sort of reassess them. You can use a little bit of hindsight. If you've got similar leases, you can actually sort of combine them together and almost do a bit of a bundling exercise. And actually, when it comes in for the first year, you don't need to go and restate your comparatives. If it was been a lease for the last 5 years, gone through your income statement, you almost look, okay, what are the next 5 years going to be? What's the difference? Any adjustment between the asset and liability will just be an adjustment to opening reserves on first time adoption. So it's not like you have to go back and apply them as if they've always been there. The difficult part is actually working out what that rate is. So when you're doing your present value calculations, you need to look at what the implicit rate of interest would be. Most leases will have interest in there. It's rare to actually see what that implicit rate is. You've got the option of almost going to the lessor and asking. Very much doubt that they'll sort of tell you what the rate would be. So if we don't know what the rate is because it's not noted in the lease itself, what do we do next? The standards are quite clear. If you can't get the rate from the lease, you can use any current or incremental borrowing, or what you could get current borrowing at, or you may be able to use sort of deposit rates as a guide. And again, from an audit side, we'd want to sort of find out what rate you've used, why you've used it, what's your comparable. rate, just so we can sort of do the check to make sure we've actually brought it in correctly. You need to make sure that the rate does actually reflect the actual liability and how it's actually being run through. As I said, documentation and disclosure will be required. There's some associations do pay tax, some subsidiaries will sort of have it, but very brief tax impact. The rules for right of use assets are different to your typical fixed asset. So your depreciation charge and your interest element would be tax allowable. You wouldn't get your capital allowances on the asset going onto your balance sheet. So timing wise, there's not going to be much of a change. You may benefit a little bit early because the actual costs hitting the income statement in year 1 will be more than it will be in year 5, just because of the write-off over time. But we're not expecting it to be that much of a change. We're waiting on further clarification from the revenue. The guidance that's come out so far has been quite basic, but we're not expecting there to be significant changes. There's a little update for potential deferred tax. So if you've got a company that is paying tax and you've got the right of use asset in there may be a small adjustment for deferred tax as well. So key changes, key takeaways, what we've got, there are a number of changes. So, let's make sure that you're happy with your income. You've quantified what type of income you've got. We see most associations are the type of income that's there, but if you're thinking about sort of doing something new, just bear in mind, is this an exchange for contract? Is this something that we need to be considering? Leases, let's start that exercise of actually going through and identifying what leases that we've got within the association, and make sure that we can capture all the data if there's any training, and that can be sort of factored in. What the impact of the changes would be, so it could be an impact on changes of income recognition, it could be covenants with leases, and any sort of adjustments that need to be sort of brought in. So consider those. As I said, the earlier planning, the earlier you can start considering these things, I think it'll just help with a sort of smooth transition across to the new standard. And then just touching back to Llinos, so there are a couple of other changes in the SORP as well. So Llinos will give us a run through on those.
Okay, thanks, Mike. So regeneration schemes. So approval of regeneration schemes is specifically listed in FRS 102 as an indicator that an impairment review may be required. The logic here is straightforward. Once a landlord commits to a scheme that will redevelop, replace, or significantly alter existing properties, there's a strong possibility that the carrying amount of those assets can no longer be justified. So at this point, the scheme is formally approved, not when the demolition starts. So not when contractors are appointed, but at the approval stage. The organisation must reassess the recoverable amount of the affected assets. That reassessment must be carried out under Chapter 12 of the Housing SORP, which sets out impairment model for social housing assets. The key requirement is to compare the carrying amount of the asset or the asset group to its recoverable service amount, effectively the higher value in use or fair value less cost to sell. So useful economic life and residual value. Approval of a regeneration plan also means the useful economic life of the asset needs to be revisited. If a property was previously expected to remain in use for, say, another 30 years, the regeneration means it will be demolished in 5. The useful economic life must be shortened accordingly. The residual value must also be reassessed. In most regeneration schemes, particularly where you're going to demolish is planned, the residual value will fall to nil because existing asset will no longer exist in its current form. These changes must be accounted for prospectively as part of impairment and depreciation review. So if you do demolish houses as part of an approved scheme, derecognition becomes relevant. So an asset must be removed from the balance sheet when it's demolished. At that point, to demolish actually occurs because the entity no longer controls it and it no longer provides service potential. So in summary, the approval of a regeneration scheme is a major accounting trigger. It requires an immediate impairment review, a reassessment of useful economic life and the residual value, and ultimately derecognition at the point of demolition. These steps ensure the financial statements continue to reflect the real economic position of the assets involved. Capitalisation of costs and incremental benefits. When we assess whether planned work should be capitalised, the key test is whether they provide an incremental future economic or service benefit. In other words, the work must enhance the asset beyond its current condition. There are several ways this can be demonstrated. For example, works that lead to increased rental income, such as improvements that allow a higher rent to be charged, may qualify. Another example is works that reduce future maintenance costs. For instance, replacing a component with a more durable one that lowers the organisation's ongoing spend. Capitalisation can also apply when works extend the useful economic life of a property. If the improvement pushes back the expected replacement or refurbishment date, that extended life represents a clear future benefit. Environmental or social benefits may also qualify, provided they create a measurable future service potential. A good example is decarbonisation works, such as insulation upgrades, solar panels, or heat pump installations, where the improvements enhances energy efficiency and reduces long-term operating costs or environmental impact. However, if the work do not provide replacement, enhancement, or future benefit, for example, routine maintenance or repairs, that simply keep the asset in its existing condition, and the expenditure must be expensed to the statement of comprehensive income. This distinction is crucial. Enhancements can be capitalised, routine repair, maintenance cannot. Non-compliance with laws and provisions. This slide summarises when provisions should be recognised, and the key distinction here is between legal obligations and constructive obligations. A provision can only be recognised when an obligation already exists, and that obligation must arise either from law, regulation, contract, or from an entity's own actions that have created a valid expectation among stakeholders. In both cases, obligation has to leave the entity with no realistic alternative but to settle it. If an organisation could avoid the expenditure through future decision or by changing its plans, then a provision cannot be recognised until cannot be recognised under FRS 102. So no provision for avoidable future costs. The standard is clear that provisions cannot be made for future expenditure that the organisation can avoid, even if that expenditure is planned or likely. This means we cannot provide for future home upgrades, future building safety works, or other improvement programmes, because these are discretionary until the organisation commits to them in a way that creates an unavoidable obligation. Restructuring provisions. Restructuring provisions are only permitted when a constructive obligation exists. FRS 102 paragraph 21 set out the conditions. They must be data planned, and the organisation must have raised a valid expectation to those affected, typically through communication to employees or to other stakeholders. Without this level of commitment, a restructuring provision cannot be recognised, even if management intends to undertake the restructuring. So the overall message is that provisions can only be recognised where the obligation is real, unavoidable, and present at the reporting date. Anything related to future, optional, or internally planned spending must remain unprovided. And that's the other points we wanted to discuss in relation to the SORP.
Perfect. Thanks, Llinos. Just have a look at the chat now. There's only one question there at the moment. Will lease accounting affect properties where you've got the leasehold title? They should be capitalised anyway as leasehold properties, so there wouldn't be any change to those. The lease accounting is where you're paying rent on, say, a short-term building where the cost is going through the income statement with no capitalisation. So it's actually taking expenses and actually sort of capitalising them. So that's where the lease accounting will change rather than sort of leasehold properties. As you see, there's a number of changes in the sector, changes in the standards. We don't know yet what the final SORP will look like. It's still in consultation. I think the consultation was closed. I think it was closed last week. Expected release date, I've been told, is right at the end of March, so just before the new year starts anyway. So we'll keep reviewing the updates to see does there anything change. We'll provide further updates when we know for certain as to what's going on. But we want to sort of do this webinar just to give an update on the sector, just to let you do some forward planning as well. So hopefully you found it useful. As I said, we're hoping to run a little bit more detailed exercises with a bit more live examples, especially around sort of lease accounting and possibly some revenue accounting later on in the year. So please keep an eye for any updates on that. As I can't see any other further questions. So thank you all for joining. We'll give you 8 minutes back, so we're pretty much on time. So thank you all, and hopefully we'll see you all soon.